Yeah, hi there. It's Bernhard Koepp at CJ Lawrence. Well, it's been a much better week this week. Markets are up about 4.6%, retracing about half of the loss of the previous high. And markets are up about 14.5% year to date. That's a lot. Remember last year the markets were slightly down for the year, given the fourth quarter sell-off. So we're still waiting for some of these political things to resolve. The big surprise obviously was the announcement of the Mexican tariffs. It's bad enough that we have one front going on with China. To open up a second front in terms of tariff wars is probably not a wise thing to do. So on Monday, these Mexican tariffs go into effect, and there's a lot of discussions going on between the U.S. government and the Mexican government to try to avert that. A lot of the recovery in the market is based on hope, obviously, that the Fed will cut rates dramatically. I mean, a lot of that is being priced into the market now. The expectation, it's just a U-turn from 3 months ago. The expectation is now a cut between 50 basis points and 75 basis points in Fed funds. The Fed funds is now well above where the 10-year Treasury is. The 10-year Treasury right now, as we speak, is at about 2.08. That's down a huge amount. If you think of the previous high was in November 8th, actually, last year. We were at 320. So, and you've taken over 1% out of the 10-year Treasury, which is a pretty dramatic change in interest rate outlook. We got some macro data just out of on the global front. The World Bank published its new forecast for global growth. They've now taken global growth from 2.9% to 2.6%. So that just shows you there's more evidence of global slowdown. I mean, yes, our economy is still doing very well, relatively well, but if the rest of the global economy is slowing down, that's not good for us either. We got some data on U.S. manufacturing. That was the Manufacturing Purchasers Managers Index. The May reading on that was 52.1. That's down from 60%, not too long ago. But a reading below 50% would be a contraction in manufacturing, which is something we're watching very closely. On the micro side, so on the stock side, it's very interesting if we look at the best performers for the week and the worst performers. So around Tuesday or Monday, Tuesday, we got more statements from government officials, this time also from state attorney generals, that they're all ganging up. They want to gang up on the big social media companies, the big tech companies. These include Facebook and Google and so forth, and to look at their dominance. I mean, as you know, we like to invest in companies that dominate their markets. That's what we call a bulldog. And it's no surprise to us that every cycle you get this kind of government backlash. I mean, I recall, a decade ago or decades ago when Microsoft went through the same thing. Typically, when the government starts regulating these big tech companies, it's kind of they're regulating what's already in the rear view mirror and has already occurred, and not really putting their regulatory stamp on what's actually the problem. So we think this is going to go on for many years, this sort of scrutiny, but as long as the companies like Facebook and Google basically have no competition for what they do, we're not that concerned about. The other thing is the valuations of these companies as compared to previous cycles is actually not that high. I mean, these companies, certainly Google, Facebook, and do not command these massive premiums that we saw in previous cycles where we saw companies that dominate this much. So the other interesting part was huge inflows into bonds. We heard from Morgan Stanley today that there was a massive inflow into bonds. I mean, this is obviously echoed by the lower bond rates that we see. According to Morgan Stanley, it's been the highest rate of inflow since 2015, which shows you how dislocated the world's capital flows are. You know, rates in the rest of the world or in Europe are at negative, so you know they're still chasing return, not of a return, but a return of money. So if people think treasuries are safe, earning only 2%, that certainly should tell you something about the outlook. Look, everybody's betting on the Fed now. It's shocking to me that how many Republicans now are counting on the Fed. It used to be that Republicans wanted to get rid of the Fed basically and have them less involved. Now you have the Trump administration, everybody basically telling the Fed you got to lower rates. The bond market is already there, so you know the Fed's hand is being played here. So it's just a very, as I said last week, a very upside down world. In terms of you know, we got a lot of questions from many of you in the last week. You know, if I could sum up, the typical question is always when we get a lot of volatility, okay, what are you doing? So, well, you know, if your money manager is doing the right thing and you get this kind of volatility and sell-off, hopefully the money manager will tell you, I'm doing nothing at all. The worst thing you can do in a sell-off like this is react to the emotion, react to the short-term volatility that is occurring in the market during that time. So the better question to ask is, you know, how do you feel about risk? I mean, if you're looking at asset allocation between bonds and stocks, that's a discussion you should have with your financial advisor or your portfolio manager. That's a long-term discussion, and you know the biggest mistakes that we see in our business is that people are underinvested. I mean, over time, equities and markets go up. The worst thing you can do is be underexposed to equities. Obviously, there are times in your life when if you're older and you're closer to retirement or you're getting ready to make a major purchase or something, you may want to be more liquid and reduce risk. So that would affect the allocation between bonds and stocks. But that's not a discussion you should be having when the markets are selling off dramatically. That's the wrong time to do that. In terms of the way we would respond, what have we done to get here is positioning. So we pay a lot of we look at our stocks very closely in terms of the macro environment that they're operating in and of course the competitive environment they're acting in. So right now we've been emphasizing stocks that have recurring revenue. I mean, we don't want to be exposed to stocks that have an overly cyclical exposure into the economy or the global economy. And obviously tariffs and you know, trade wars, things like that affect that group of stocks. So we've been doing that already since January before we saw this round of volatility. We're obviously underweight cyclicals. So we've eliminated, I mean, a year ago, we still had some more exposure into materials and chemicals and things like that. That's pretty much all gone. We're watching financials very closely. We're underweight banks, but we still have some exposure into two banks there. But we need to watch that very closely. Banks are sort of the canary in the coal mine to tell you how sound and you know the outlook certainly is going forward. Banks do much better when the yield curve is steep. Certainly an inverted yield curve is not a great thing for banks, so that's the reason they're not performing well. Our models, our CJ Lawrence market monitor model still points to an attractive reading for equities. You know, we don't think we're going into a bear market. The majority of our accounts, whether they're growth accounts or balanced accounts, are still up quite a bit this year. So we're quite happy about the returns that we're achieving in our style this year. So, we continue to watch everything from the political things that are going on, and we're watching earnings very closely. But again, we're still quite positive on equities versus bonds. So if you need to discuss your asset allocation, certainly call me, but we would argue and advise you to stay the course. That said, I wish you a good weekend, and we'll see you next week.